Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week focuses on Nigeria's Q2 2024 GDP report. Last week, the National Bureau of Statistics (NBS) published Nigeria's second quarter gross domestic product numbers for 2024. The Nigerian economy experienced growth for the 15th consecutive quarter since emerging from the recession in 2020. Real GDP rose by 3.19% year-on-year in Q2 2024, higher than 2.98% year-on-year in Q1 2024 and 2.51% year-on-year in Q2 2023. The improved growth rate in Q2 2024, April to June 2024, relative to the previous quarter, January to March 2024, can be attributed to the impressive contribution from the services sector. GDP is a crucial indicator that measures the overall performance of an economy by assessing the total value of all final goods and services produced over a specific period, typically a quarter or a year. Real GDP provides a more accurate representation of the actual value of goods and services produced, unaffected by price changes. Simply put, changes in the GDP of a sector can result from variations in both the quantity of the goods and services produced and their respective prices. However, what truly matters is the increase in the quantity of goods and services produced rather than price fluctuations. Nigeria's GDP report captures 19 sectors, but only 5 sectors account for 69.81% of the economy's total activities. These are agriculture 18.5%, trade, wholesale and retail 16%, ICT 14.2%, manufacturing 12.7%, and construction 8.5%. The non-oil sector, which has been the primary driver of the Nigerian GDP growth since Q4 2020, accounted for 94.3% of the GDP in Q2 2024, compared to 93.6% in Q1 2024. The sector grew by 2.8% year-on-year in Q2 2024, unchanged from Q1 2024. There was also a broad-based expansion across the structural sectors of the economy. Services had the strongest growth rate at 3.8% year-on-year in Q2 2024, despite a slowdown from 4.3% in the previous quarter. There was a strong rebound in agricultural growth as the sector grew by 1.4% from 0.2% in the prior quarter, while industry sustained its expansion at 3.5% from 2.2% in the previous quarter. On the other hand, despite sustained weakness in oil production volumes, which was the lowest in 4 quarters at 1.4 million barrels per day in Q2 2024 from 1.57 million barrels per day in Q1 2024, the oil sector grew strongly by 10.2% from 5.7%. The growth in the oil sector is merely statistical, driven by the slump in oil production to 1.22 million barrels per day in Q2 2023. Hence, it does not reflect better fortunes in the sector. Based on the contribution of sectors to GDP, the services sector picked up momentum, 58.7% in Q2 2024 versus 58% in Q1 2024, and agriculture improved 22.6% in Q2 2024 versus 21.1% in Q1 2024, while the contribution of the industry sector moderated 18.6% in Q2 2024 versus 20.9% in Q1 2024. Our takeaways: 1. 17 of the 19 sectors expanded in Q2 2024, save for transportation and storage sector and other services sector. The negative growth rate in the transportation sector may be attributed to the rising cost of transportation due to fuel scarcity and higher fuel prices. 2. Despite the 10.2% quarter-on-quarter decline in oil production, the oil sector grew by 10.2% year-on-year, largely due to the low base effect of the negative growth rate in Q2 2023. The oil sector will remain challenged due to the low investment in the sector and lingering insecurity. 3. The agricultural sector growth improved by 1.4% year-on-year in Q2 2024 relative to 0.2% year-on-year in Q1 2024 due to significant improvement in the livestock, minus 1.7% in Q2 2024 versus minus 23.3% in Q1 2024, and fishing, minus 1.4% in Q2 2024 versus 0.4% in Q1 2024. Subsectors: crop production growth rate growth moderated to 1.65% in Q2 2024 compared to the 1.71% in Q1 2024. This highlights the ongoing insecurity in the food producing areas. However, we expect improvement in the following quarters due to harvest season and the government's plan to deploy 10,000 agro rangers across 19 food producing areas and the FCT. 4. Growth in the ICT sector slowed, albeit positive 4.4% for the fifth consecutive quarter due to slowdown in growth in the telecommunication and information services subsector, which moderated to 5.2% year-on-year in Q2 2024 relative to 6.2% in Q1 2024. This can be linked to the FX volatility, which may affect capital and operational expenditures as well as constrained consumer wallets. We expect demand for data to continue to support growth in this sector. 5. The financial and insurance sector's growth slowed to 28.8% year-on-year in Q2 2024 relative to 31.2% in Q1 2024 due to slow loan growth due to higher interest rates. The bank's current recapitalization exercise is expected to boost business activities. 6. Growth in the manufacturing sector slowed to 1.7% compared to 2.1% in Q1 2024 due to lower production and shrinking consumer demand due to high inflation rate and borrowing costs. The sector may continue to struggle due to those factors. 7. Trade sector growth softened for the third consecutive quarter to 0.7% year-on-year in Q2 2024 compared to 1.2% year-on-year in Q1 2024 due to the Naira devaluation at the official window. This increased the cost of clearing imported items, leading to slower demand. Higher interest rates also impacted the sector. This is expected to linger until FX stability and liquidity are achieved. 8. The depreciation of the Naira, which led to an increase in maintenance and repair costs, slowed real estate growth to 0.75% in Q2 2024. GDP growth is projected to stay around 3% levels in Q3 2024 thanks to the boost from the services sector, as substantial spending on data and voice services will continue to support growth in the telecommunications sector, while higher interest rates will bolster non-lending growth in the financial sector. However, the persistently high inflation rate, the devaluation of the Naira, and the anticipated increase in energy prices, petrol and electricity will continue to restrict growth in the non-oil sector. Additionally, higher interest rates will result in increased financing costs for the manufacturing sector, potentially impacting companies' profitability. Thank you for listening. Please join us same time next week for another exciting, interesting and insightful session. For questions, comments and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed.